Good evening, class, and welcome to our advanced taxation class this evening. Our topic for today is merger and acquisitions. Merger and acquisitions. Okay? Yeah, someone said I thought it was PPT. I said in my message, might. I wanted to take that topic as the last topic so that we'll dwell some time on it. So, our topic for today is merger and acquisition. All right. So, let's look at what merger is. We're going to be looking at benefits of merger and acquisitions. We'll look at something called merger, acquisitions, and takeover. Then we'll look at the basis period for assessment where there is merger and acquisition. What are the tax considerations for mergers and acquisition? And we'll be looking at tax planning options under merger, acquisitions, and takeover. Okay, so let's go straight down into the whole process. Mergers and acquisition. What is a merger? What is an acquisition? These are forms of business combinations. And so when we say business combinations, we mean combining of one or two or more businesses to form one for the purpose of business. So merger and acquisition is a form of business combination whereby two or more companies join together to become one enlarged surviving company. It can be described as an arrangement in which assets, liabilities, and businesses of two or more companies are vested in and carried on by one company in which that company may not be one of the merging companies. Let me give you an example now. You know when if you've heard of um Sterling Bank, no, okay, Sterling Bank. Sterling Bank is a result of a merger. About five banks or so came together, recapitalized, and formed Sterling Bank. And so Sterling Bank was not in the picture, it was a new company that was formed as a result of that merger. Now, do you also remember this bank called Standard Trust Bank? Standard Trust Bank was acquired by UBA. And so you don't see anything like Standard Trust Bank anymore, right? UBA. What about Oceanic Bank? Oceanic Bank used to be there, but it was acquired by what? EcoBank. What about Intercontinental Trust Bank? This was acquired by what? Access Bank. Then sometimes you see, do you hear of Diamond Bank anymore? Now, Diamond Bank is a merger between Diamond Bank merged with Access Bank, and Access Bank now became the surviving bank, carrying on that name. So I've given you examples of mergers whereby, like in the case of Sterling Bank, It came into existence, and all the people that merged went out of existence. I've given you example of another type of merger, Diamond Bank and Access Bank, where Diamond Bank was not surviving, Access Bank was the surviving. I also gave you an example of acquisition, that of Oceanic Bank being acquired by EcoBank and Standard Trust Bank acquired by UBA. And so, how I will describe a merger could be likened to two people coming together to share the rent of an apartment. All right? Two people coming together to share the responsibility of paying the rent. And so, one of them would be the one whose name is in the agreement, but the two of them are paying the same bills. They're sharing 50-50. And so that's merger. It could also be like the coming together of a husband and a wife to live together. That is a merger. Now, acquisition could be likened to you you acquired a property, or maybe you brought a servant. You own that person. You own the time of that person. The person is not paying the rent anymore. You have taken over his responsibilities. You are the only one paying the rent, and the person is there. And so when you shout, jump, the person says, how high? So it means you own that person. So when you say acquisition, in our knowledge of financial accounting, it means you must have about 51% of shares minimum, and it could be a full acquisition, which is you may have 100%, but anything from 51% to 100% is an acquisition. So you have control. You're having control over the uh, assets and the business of that company that was acquired. Now we have two types of measure. We have horizontal measure, which is the one involving the same company in the same line of business, like the ones I told you in the banking sector, where two banks merge together to become one full bank. That is horizontal because they're in the same line of business. So horizontal is you go in the same level. Vertical means you are in the same type of industry, but one of them is the supplier, the other one is the kind of one is the supplier to the other. For example, you can have a warehouse that has a manufacturer supplying them the drinks. Or you could even say, okay, somebody is manufacturing, it's a manufacturer of soft drinks, and he merged with somebody who is supplying the raw material. Raw material could be like bottles, could also be like crates, could also be like the crank cork, could also be the main ingredient used in making the soft drinks. Yes, they are in the same industry of making drinks, but they are not in the same line. For example, Nigerian breweries and Guinness breweries, if they come together, that would be horizontal merger because they're in the same line of business. But Nigerian breweries and Nigerian bottling company, these are in the same industry, but the bottling company will be the supplier to the breweries. So that's an example of a vertical merger. An acquisition is said to involve the purchase of all or majority of the equity shares of one or more companies, where one of the companies will have at least 51%. Or it could even be 50.1%. As long as it is more than 50%, that person holds controlling rights. And the other person whose shares is being held becomes a subsidiary. So you will be asking, what are the benefits of having a merger and acquisition. Why would I want to go and merge with another company? Why would I want to acquire another company? Here are some of the benefits. One of them is improved management. All right, let's give an example now. We see recently Heritage Bank went under the bus. They were they were sacked from the industry. Now, if they had merged with another bank, maybe because they have poor management of funds and all that, if another bank had been able to merge with them or acquired them, they would have gotten the benefit of improved management. And so some people, instead of being sacked out of the industry, they will rather want to merge so that they will have improved management. We have operating economies. So we have economies of scale. Economies of scale is usually used for when you want to produce a large quantity. When you produce a large quantity, the cost is cheaper. And so when you are merging with another company, let's say, for example, um, let's say a transport company, let me use a transport company, the Young Shall Grow. Assuming it goes from Lagos to Abuja and covers the southwest and perhaps southeast and maybe south. If you have another transport company that is covering the north, you could operate together and merge so that you have economies of scale. So when you are operating in a larger scale, your cost is small. And so that is some of the things that will make people to go into merger or acquisition. Then we have growth. When you are growing, how will your growth be seen? Your growth will be seen in you opening branches, or you could see you getting market share. That is growth, market share. So our market size. So you can imagine a company that is only running in Lagos and Abuja, transport company. If it now captures another company that is running from Lagos to Port Harcourt, and and that same company is running from maybe Port Harcourt to Calabar, it is growing. So before you know, you say, this vehicle or this company is reaching these places because of that merger. Or like the example I gave covers the north. That shows you are growing. Then it means that how many buses now will you have? So since you have merged your assets and liabilities together, you will count the number of buses from the two companies, and that shows your growth. That's why banks recapitalize, they grow when they merge. Because when they bring all their assets together, their capital base together, they are growing. What about tax shield? Tax shield is another factor that makes them want to merge. So sometimes, you know, because some people are having some favorable advantage and some are having less advantage when it comes to tax, they try to merge in order to shield them from the tax deficiency or tax exposure that they had before. When we talk about tax implications, some of these things, you will see the tax shield. Increased market power. This increased market power could also be linked to growth. Increased market power, market penetration. When you are covering more places, your market power is increasing. How will you know your market power is increasing? Your market size. Your market size increase. Then there's something called market share. So you have 100% of the population. What is your share? If you are having before 30% of market share, and another company that is having 20% of market share, if you can merge, or if you can acquire that, perhaps maybe merge, you your share would now become like 50%. So you have increased your market power. Then there's improved financing because contributions coming from this quarters and from that other quarters, and so your financing has improved. Also, if you are also merging or horizontal and vertical, sometimes you have improved your financing in the sense that somebody who is supplying you your raw material, the person who is getting this raw material supplied to you will have no doubt that you will buy from them, and that increase their financing power. Sometimes they could even take credit from you. And so when they are buying credit from you, and they are, by virtue of the fact that you have merged with them, they have kind of increased your financial power because you have not paid that money, but you are using it to finance your business. And so you have that advantage. Then there is diversification and risk reduction. So if two companies that are not in the same industry, they they merge. Okay, let's see an example. Let's say a an ice cream company and an umbrella company merge together. What a combination, right? If the weather is hot, you want to take ice cream, right? You'll be buying ice cream, you won't buy umbrella. When the weather is cold, you won't be taking ice cream, right? You'll be buying umbrellas. And so you have diversified your risk such that in every time of the year, you are always making revenue. You won't say your revenue is always on the dry season because you're only selling ice cream, or your revenue is only on the rainy season because you're only selling umbrellas. So when you diversify like this, you have reduced your risk. And so people diversify by merging and reduce their risk. These are some of the benefits of merger and acquisition. Now we want to look at mergers and acquisition, the powers granted to the FIRS. Before any company has to be merged, they have to seek the consent of the Federal Inland Revenue Service. You know, every company pays their tax to the FIRS. And so before you merge, you must seek the express approval of the Federal Inland Revenue Service, and that will include clearance with respect to any capital gains tax that may be due and payable before the merger or the takeover or the transfer or restructuring of the trades can take place. So it means that you cannot do anything without the FIRS. And of course, though it is not mentioned here, the CAC also will need to be notified. Now, the Company Income Tax Act gives the FIRS power to the extent that no merger can be consummated without the consent or direction of the FIRS. So that is the case. Now, what are the tax implications of mergers, acquisitions, and takeover? Now we'll be looking at examples, and I'll be telling you the tax implication. Now, tax implication of amalgamation. Amalgamation is another name for merger. So when you now see the question amalgamation, you will not say, the lecturer did not teach you that. Merger is amalgamation. Of course, when the word amalgamation is mentioned, some of us here in Nigeria will now think of when the northern and the southern part of Nigeria was amalgamated in 1940. That's another merger. So when they joined together to form one, that's a merger. So when you hear amalgamation, it's a merger. Absorption. For those who just came from performance management class, absorption, is another word for acquisition. acquisition is absorption. Then take over is a thing of its own. Now, let's look at the implication, the common possibilities. One, new company takes over an existing company. New company takes over an existing company. Now, where a new company takes over an existing company, the old company is deemed to have ceased business, while the new company is deemed to have commenced a new business. So the old company is going away, the new company is starting because it's a new company. It means it was registered, incorporated, so that it will be the one to run the affairs of the existing company. So the existing company is ceasing, going out of the system, and so the cessation rule will apply, and the commencement rule will also apply. So the tax implication is the old company, the existing company will cease. Cessation rule applies. You know all the cessation rules now, right? You will now look at the date of cessation. The date of cessation is the date the merger takes place. Of course, you will now file cessation return 6 months after, which is the due date. We learned that in the cessation rules. So refresh your cessation rules and apply it to this case. The new company will start commencement rule. Now, another tax implication is filing of annual returns. The new company that emerges from the merger is expected to file audited accounts and returns with the FIRS within 18 months from the date of incorporation, or not later than 6 months after its first accounting period, whichever is earlier. So it means that from the date of incorporation, give yourself 18 months. It doesn't matter whether you have started the business or not, 18 months you must file annual returns. If you have not started the business, you need to file statement of affairs. If you have started the business and you have your account year end, you need to file within 6 months after the end of the accounting period. So whichever comes first, 6 months or 18 months from the date of incorporation, you must file your first annual return. Note that a mere change of name of an existing business entity does not constitute a new company. For example, GT Bank changed their name to GT Co. That doesn't change the existence of the business. So that is not treated as a new company. Okay, so that's it. So, but in the case of where Sterling Bank was coming out and other banks that gave rise to Sterling Bank, uh, some of these banks were leaving the scene. Now they are going to be making cessation rules. Sterling Bank is going to make commencement rule. Then the basis of assessment, we said commencement rule will apply, and with the new Finance Act, there is no right of election. There is no right of election with this new Finance Act. So take note of that. Except if the merger took place before the commencement of Finance Act 2019. That is when the right of election, we'll be talking about right of election. Somebody is asking, what about Access Bank change its name to Access Diamond after the acquisition of Diamond Bank? Now, Access Bank and Diamond Bank, we'll talk about it. Now, Access Bank is still in the business. Diamond Bank is the one that is going to cease business. Diamond Bank will do their cessation rule. Access Bank is continuing. So there's a going concern, they will continue their tax as though no cessation rule, no commencement rule. We'll come to that. Then there's a claim of capital allowances. No initial or investment allowance will be claimed on the transferred assets. So it means that when those companies like those other companies, I've forgotten, Magnum Bank was one of those that fizzled out to become Sterling Bank. I can remember Magnum Bank. So let me use that word, Magnum Bank, as an example. When it is transferring its assets to Sterling Bank, the Sterling Bank will not experience initial allowance. Why? Because initial allowance has been claimed by Magnum Bank. So Sterling Bank will not claim it. Then there is no going to be investment allowance because those assets were claimed. This investment allowance and initial allowance has been claimed, and these are one-time claim on them. The only thing that will be claimable is a um, annual allowance on the unexpired life of the asset transferred. What it means is that if an asset was used for just 1 year, after 1 year, it has it is now transferred to another to the other company. Maybe the asset has 4 years, maybe a vehicle has 4 years. It has been used for 1 year. So the remaining lifespan is three. Let's say, for example, it has been used for 3 years before it is transferred. The unexpired life is 1 year. And that is only when the capital allowance will be claimed. Now, the unabsorbed losses, what happens to it? Unabsorbed losses and capital allowances brought forward. What happens to losses? The unrelieved losses and unabsorbed capital allowance of the individual merging company will not be carried forward and set off against the accessible profit of the new company after the merger. What happened is this: we said unrelieved losses is lost forever. So what happens? Once, let's say Magnum Bank, when it was going away to becoming Sterling Bank with other banks, if they have a loss that they have not cleared, that loss is lost forever. But if they have capital allowance that has not been utilized, what happens? We learned that they can carry it backward for a maximum of 4 years. That is what will be done to unabsorbed capital allowance. What about stamp duty? Stamp duty will arise on share capital of the new company. So because the new company will be offering the old existing company shares, when they buy shares, if the merger results in increase in share capital, so it means that if Access Bank and Diamond Bank is merging, and now that means that the Access Bank will now be the one to survive, it means that the shares of Access Bank will increase as a result of the merger. And so they are going to pay stamp duty on the new shares that will be paid to the share capital, right? Besides, merger of companies will also involve sale and transfer of assets of the merging company to the new company. And so it will require transfer of or sale of documents must be reflecting the change of title. When those sale of documents, when the sale of assets document is being prepared, stamp duties will be paid on those documents to reflect the title's change. Stamp duty will be paid. So we look at it now. We've seen annual returns, basis period, commencement or cessation, capital allowances that are claimable, unabsorbed capital allowances and losses, stamp duty. What about the merger cost? The merger cost itself is one of the things that will be borne by the merging company. There are some of the costs which are incurred in the merger, which will involve the use of professionals. So you might be seeing solicitors, estate valuers, stockbrokers, accountants, tax professionals, corporate affairs commission, Nigerian Stock Exchange, all of these merger costs must be involved. And how do we treat these merger costs? They are treated as capital costs, and so they are not allowable expenses. So anytime you see your tax filing, your tax computation, that you see merger costs, okay, costs incurred in merging, in the process of the merging, these costs are treated as capital costs, and uh, they are not tax deductible. Then we have the value added tax and withholding tax. Now, when you pay the professionals, the stockbrokers, the valuers, when you pay them their fees, what must you do? You must withhold part of their fees. So withholding tax is liable on whoever is withholding. Then value added tax is being suffered when they are giving you a value added services. So it attracts value added tax and withholding tax. Then we have guarantee or security for payment of tax. The FRS may require the new company to give security to the satisfaction of FRS for the payment in full of all tax due or to become due by any of the seized companies. So the new company will say, they will be asked that, okay, to give us a guarantee that these companies that are fizzling out will pay all their taxes due, please give us a guarantee or security for the payment of tax. So this is likely what their taxes are going to be. Can you pay that? So that when these people are paying in full, then we know that you have you have done your part. If they fail to do it, we will take that guarantee as their payment of tax. So that is likely going to happen. End of service award. When companies merge, the services of some employees may no longer be needed. The new company may have to pay benefits such as gratuity, compensation, loss of employment, or other retirement benefits like pension. These expenses will be treated as allowable for the new company. So you can see here that when a new company, this is a new company that will start from the date of the merger. The existing companies will end on the date of the merger. So this is not the Access Bank and the Diamond Bank issue. This is like the Magnum Bank and the Sterling Bank issue. So this is the kind of thing that happens. Now let's look at where an existing company absorbs another company. Now, absorption is what we're looking at here now. This is the kind of situation between UBA and Standard Trust Bank, or Access Bank and Intercontinental Bank, or we could say Oceanic Bank and EcoBank. So because the banking industry gives us a perfect example for this topic, where an existing company absorbs another existing company, the company absorbed, I'm using the case of which one should I use? UBA and STB. UBA, STB, Standard Trust Bank. Now, the absorbed company, which is STB, will be deemed to have ceased business, and cessation rule will apply to it. The company that absorbed UBA will not be deemed to have commenced a new business. So you see, UBA is not going to be seen as commencing a new business. Why? Because the nature of the business carried on by UBA before the absorption and after the absorption are not different. UBA is providing banking services before it absorbed STB. And when it absorbed STB, it still carried on, right? Except if maybe UBA maybe absorbed OPay or a microfinance bank. And now OPay is a kind of is different kind of banking, and then UBA is different kind of banking. Then we can say there is a nature of business that was not being done before that is being carried on. That is a different thing. But in the case of STB, UBA, the business nature is the same. Therefore, commencement rule will not apply to it. What about the situation where UBA absorb Hair Holdings? I don't want to talk about holding company because holding companies are the parent companies of another. And the parent company, these are group of companies. So let us stick to these ones that are the same line of business. If they are the same line of business, they will not be seen as carrying on a new company. Questions are still coming. Oil and gas. Oil and gas is a different nature. So that aspect of oil and gas will be seen as a new business for the person that is taking over. So it means that means it has two lines of business. Banking, the banking side will continue, whereas the new one that is now being added to its memorandum or article of association will not be a new business for it. All right. Then the surviving company will not be entitled to investment allowance and initial allowance on the asset transferred to it. So you see here, whenever there is a transfer of assets, do not give investment allowance, do not give initial allowance, but the annual allowance will be claimable on the tax written down values as long as the life of the asset has not expired. If it has expired, the annual allowance will still not be claimable. Also note that losses that is made by the business that is going away, which is the old business, will not be absorbed. Capital allowances too also will not be absorbed, as in the case of that other one. Then we look at financial services that will subjected to VAT and withholding tax. Then we also have increase in share capital. Now I want us to look at what are those things that are common to them. What are those tax liabilities, those tax implications that are common to them? Increase of share capital is common to the first and the second one. The payment of VAT and withholding tax common. Unabsorbed losses and unabsorbed capital allowances not being transferred common. The assets transferred at net book value is common, and only the capital allowance for annual allowance will be claimable on the unexpired life. That's common. The thing that is not common is cessation rule and commencement rule. So we'll now look at it now. If it is existing businesses merging or coming to absorb another, commencement rule will not be on the existing business as long as they're in the same line. That's the new thing. That's the new thing. Yeah, they give us an example here that commencement provision will now apply to it when it is filing its tax returns. This is what happened when MTN absorbed Visa phone. Yeah. Visa MTN was treated as an ongoing company while cessation was applied to Visa Phone. So you are seeing it in that case. So this is the tax implication now for an existing company taking another existing company. We have seen new company taking an existing company. Let's see another type of business combination, merger resulting in the cessation of business of merging companies. Cessation of business of the merging companies. Where a merger results in the cessation of business of all the merging companies. Cessation provisions will apply to those companies that have ceased business permanently. That's fine. This is like a summary. Any unrelieved capital allowances can be carried back for 5 years. I mentioned 4 years before, right? It's 5 years. Any unrelieved loss cannot be carried backward. They have lapsed. Any sum received or paid by the company, its receivers or liquidators after the date of cessation will be deemed to have been received or paid on the last day before the cessation occurred. So it means that if the cessation occurred on December 31st, maybe a merger starts January 1, and you now paid maybe February 14th, you now paid your liquidators, your bankers, you paid your lawyers, your CAC, you paid some of the estate agents on that date. It is taken as though you paid them on the date that the cessation was done. Okay, so this is like a summary of those things that we've mentioned in the beginning here. Then trade or business sold or transferred. Now this is another kind of summary here. If a trade or business is sold or transferred to a Nigerian company together with any assets employed therein, and the revenue service is satisfied that one of the company has control over the other, or that both are controlled by some other persons or members of a recognized group of companies, then the following will happen. Commencement and cessation provisions are not applied. That is to the people who received it. For capital allowance purposes, the assets sold or transferred shall be deemed to have been sold to an amount equal to the residue of the qualifying capital expenditure, that is the net book value. And the company acquiring the assets shall not be entitled to any initial allowance or investment allowance, and shall be deemed to have received an allowance already granted to the vendor company up to the date of the sale of transfer. Now, there is no reference to unutilized loss incurred in the old trade. Such losses cannot be transferred to the new business, as we've said before. So we've seen two types of things here. We've seen old companies going out, a new company is taking over. We've seen existing company taking another existing company's business. Now let's look at reconstituted company. Chapter 3 of Part 2 of the Companies and Allied Matters Act states that the reconstituted company is incorporated to carry on a trade or business previously carried on by a foreign company, and the assets employed by the foreign company in that trade or business vest in the reconstituted company. So what it means is that if a foreign company was carrying on a business in Nigeria and a company is now registered in Nigeria to carry on the trade that that foreign company was carrying on in Nigeria. What is example of that? Let's say in the pharmaceutical company we have GlaxoSmithKline. So as they are leaving, another company was incorporated in Nigeria because we said um, residence of a company in Nigeria is through incorporation. Now, when a new company is incorporated in Nigeria, we can just call that one GSK or GKS or which one? Nigeria is carrying out those foreign companies' operation. They are reconstituted companies. Now, commencement and cessation provisions shall not apply to the reconstituted company. Now, can you see the difference? A new company was formed to carry on the business of a foreign company that was there before. Did you notice that when we treated existing companies going away and a new company is taking over, we said commencement and cessation was happening. But in the case of reconstituted, it is not happening. The assets vested in the reconstituted company shall be deemed to have been sold to it on the date of incorporation of that company for an amount equal to the residue, which I will call the carrying amount of the assets. Once again, reconstituted company shall not be allowed to carry to entitle of any initial allowance or investment allowance of the granted to the foreign company. Unrelieved losses of the foreign company on the date of the reconstituted, unrelieved losses of the foreign company on the date of the reconstitution shall be deemed to have been incurred by the reconstituted company on its first year of assessment. Now, we are going to be seeing these things here now. Now, constituted company is having some elements of continuity. So you see why initial and annual, you see why commencement and cessation rule will not apply. It is as though the foreigners are going away, but their business remain. That is why it is called reconstituted company. Their business remain, they have gone away. They have sold their assets, yes, fine, but the name also kind of remain. It's a reconstituted company. That is what it will show in their memats. So no cessation is as though they are, since they are carrying on that existing company's mandate or business, so it is as though the old company never ended and the new company never started. And can you see that? Because even though the old company physically have gone away in principle and they have sold that their assets to the new company, it's as though they never even sold it. So it is being carried on the net book value. It's just going to continue as business as usual. And now, any loss that the foreign company makes, it is going into the new business as if it is being made in the new year, in the first year of the business. So when the business makes a profit, you will see it will bring unrelieved loss brought forward. So it will be as though they have made, say, what about if the new company changes its name in the case of the reconstituted company? As long as it is a reconstituted company, we said changing of name is not a criteria that you must have continued a new business. We said the example of GT Bank changes its name to GT Co. If MTN changes its name to Empty Hen, as spelled empty and hen, it is not a case of a new business because the business is still continuing. Now, reconstitution now means that the foreign element has gone away. It is only the Nigerian element that is still there, and they are carrying on the same business. So that is what it means. The foreign participation has left. They have sold their participation. So if they have sold their shares, they have sold their entitlements, they sold their assets, they are no longer in charge and they have gone. So the new reconstituted company, whatever name it is carrying on the business. And so no cessation rule, no commencement rule. The losses are seen to have been made on the first year of the accessible profit and shall be deductible from its accessible profit. Now, they said losses arising from damages caused by civil war cannot be so transferred to the reconstituted company except with the approval of the Federal Executive Council. This is specifically mentioned civil war. So if there's a civil war and this happened to make a loss, foreign participants make a loss, it cannot be transferred to the reconstituted company without the approval of the FEC. It is to be noted that a claim for the deduction of such loss must be lodged with the Director of the Inspectorate Division of the Federal Ministry of Industries with a copy to the Revenue Service within 3 years of the incorporation of the reconstituted company. Deduction of such loss is to be made from the accessible profits of the reconstituted company for the first year of assessment, and so far as it cannot be made, it will be carried on up to the fourth year of business. So it means that if the loss is transferred and it cannot be cleared in the first year, to be taken to the second year, taken to the third year, taken to the fourth year. They say the foregoing is only applicable if the revenue service is satisfied that the trade or business carried on by the reconstituted company immediately after its incorporation is not substantially different from that previously carried on in Nigeria by that foreign company. For example, MTN Nigeria is a foreign company, right? God forbid, if MTN is leaving, a lot of us will not have network. And let's say a Nigerian company decided to be reconstituted. So, and they are doing the same thing MTN is doing, then this is going to happen. Or let's say multi-choice. It's another example of South African company, foreign participation, and we all like DSTV and GoTV, and they want this to continue. So this is an example of reconstituted. Has to be a Nigerian company carrying on a business that was done by the foreign company, and it is seen as though the foreign company is still in existence. So that means if it is MTN leaving, the South African participation leaving, the network will still be ongoing, everybody will still be using it, but it is a Nigerian company now. It is reconstituted. All right. Advice on entities involved in business reorganization and restructuring. Advice on this reorganization. Tax concession. Where the business reorganization or restructuring, which could be either merging or absorption, and they say sale or transfer among entities are related. Where these are related, so that there is a clearer, um, there's a clearer definition. Where these are related, decision. The commencement and cessation provisions are not applied. So, okay, so this is reorganization, restructuring. So this is a restructuring. There's a sale or transfer of assets. So most times this happens in merger or acquisition. The commencement and cessation provisions are not applied. Now this will occur mainly on the surviving company. The capital allowances, for capital allowances purposes, the assets or the assets sold or transferred will be deemed to have been sold for an amount equal to the net book value. So what it also means that even though you sold it for higher or lower than the net book value, in your books you will record as though it is sold at the net book value. That is the nominal value for it. Any excesses you made is a premium. Any losses you made or deficit you made is a discount. But you will not say because you sold it at lower value, the tax authority will be deeming it that it is sold at the net book value. The company acquiring the assets shall not be entitled to initial allowance and shall be deemed to have received all allowance granted to the vendor company up to the date of sale or transfer. These are even say the same things that we have said. This is reiterating it. There is no reference to unutilized losses in the old trade. This is the same thing that we said before. Conditions to be met before qualifying for such tax concessions. The Finance Act 2019 introduced amendment to Section 29, subsection 9 of CETA to the effect that qualification for exemption from commencement and cessation rules in a business restructuring amongst related parties to now include requirements to be related for a period of at least 1 year prior to the restructuring. So it means that if you are related parties, if there's a related parties and you want to do a restructuring, okay, so for related parties, you must have been related for at least 1 year. No disposal of assets post restructuring until after 1 year. Flouting of this provision will lead to revocation of the exemption. So all these exemptions that we are seeing here, it will be revoked if these are not kept. So, but mostly what is popular in your examination is merger, acquisition, and sometimes reconstitution. All right. Main highlights: emergence of a new company. So you see here that It doesn't matter if it is absorption or merger. If there is a new company that is coming to existence, so once you see that a new company, so what you need to do is look at the business organization or reorganization or business combination. Will it require a new company being formed or imagine? If it's going to happen, then look at the tax implication for this new business. One, it must render annual returns 18 months after incorporation or 6 months after its first year of assessment, whichever comes first. Commencement rule will apply. It will claim annual allowances on assets transferred. It will not take in unabsorbed losses or unutilized capital allowances. There will be tax and tax related expenses. Of course, some of these things could be stamp duties, it's a tax related expense, fees for SEC, NSC, CBN, landed authorities, professionals. Then there is also going to be value added tax liable on professional fees that they will pay, and they will also have to withhold the tax deduction from professional fees. These are the tax related expenses that is going to happen. Now, where one of the merging company survives with its old name or a new name. So now you see there is a survival. Now this is not a new company. It has been in existence and there is a merger and one of them is surviving. The surviving company must file returns not more than 6 months after its end of this accounting year. So it means that it is still seen as continuing. So it must continue to file its annual returns or file its tax returns 6 months after its end of accounting year. Commencement rule will not apply because it is still a survivor. No initial allowance, no investment allowance, only claiming of the tax written down value of the assets inherited. They are not going to inherit unabsorbed losses, no unutilized capital allowances, and they are still going to pay VAT and withholding taxes, stamp duty paid on increase in share capital. Just remember some of these tax implications when you say that this is a surviving company, not a new one now, a surviving company. Now, the next one is where there is a cessation of companies during the either merger or acquisition. You see that cessation rule will apply. Now, when there is uh, um, related parties, when there is a related parties, according to section 29, subsection 9 that we read before, cessation rule may not apply to them. So they just end the end. So no cessation rule. Then cessation rule may not be applicable where a reconstituted company is formed to take over the trade of business formerly run by its parent foreign company. So the parent company is leaving, the subsidiary or so is formed to take over. So there is not going to be a cessation where a reconstituted company is formed. So that's it. These are the tax implication. So you can, so this is like the summary, the main highlights. If you can remember these things here, then all the things we have been saying for the past about an hour or so is sinking in. Capital gains tax, where the shares of the acquirer are issued in exchange for the shares of the acquired company. So it means that UBA was the acquirer, STB was the acquired, and now UBA is issuing a share for the shares of um, STB. So this is share for share exchange. This transaction is exempted from capital gains tax. So you see here, if they say for every for every one share, you can say for every 3 shares UBA give to the shareholders of STB, UBA will take 5 shares. So it means 3 shares of UBA going to the shareholders for STB, then STB will give 5 shares. So that is a share for share exchange. No money exchange hands. And so they have exempt capital gains tax. So one of the tax planning things you should do in order to reduce your tax liability is to do share for share exchange instead of outrightly buying shares. That will save you from stamp duty and save you from capital gains tax. However, where the shares are wholly or partly paid in cash for surrendering their shares in the seized business, the gains arising from such cash payment is subjected to capital gains tax. So you see, capital gains tax now has now entered into the tax consideration. So it's possible there will be share for share exchange or share cash for shares. Now, tax planning under mergers and acquisition and takeovers. Mergers. In merging, acquisition and takeover, look at some of the tax planning options. One, merger consideration pay off by shares. These are not liable to capital gains tax. So when we see share for share exchange, it is not liable to capital gains tax. And so that's one way you can do your business organization take over and all that, and you reduce your tax exposure or your tax liability. Two, whether the merger is between related or unrelated companies, where the assets of the company are taken over at market value, capital allowance will be claimable on the transferred value as against the tax written down values with the concept of the FRS. So you see here, if you decide to take it at market values, now capital allowances will be on the transferred values, that is the market values. So sometimes the market value may be higher than the tax written down value, right? And so you are taking over at market value. When you write to the FIRS and you're taking it at market value, what have you really done? You're taking it at arm's length value, right? Even if you have taken it at tax written down value, it's still arm's length. But although the tax written down value is going to be smaller, but you see market value is going to be higher. And so you can claim more capital allowance with market value than with tax written down value. So when you tell the FIRS that you want to take them at market value and with their consent they allow that, that's a way of tax planning. You get more capital allowance given to you. Where the new company is deemed to have commenced a new business, the taxpayer option, which is called a right of election, should be applied. But in the case of the new Finance Act 2019, there is nothing called the right of election. So this is only applicable when the merger or so is done, maybe 2018. If it is done in 2018, then right of election might partly occur. 2017, right of election will occur. But from 2019, right of election is will not occur, because everything in every the basis of assessment for taxes now will be at preceding year basis. And so if it occurred in 2019, 2020 become the year of assessment, and under the new Finance Act, the right of election has been removed. Where the company is deemed to be continuing in business, any unrelieved loss of the individual company can be carried forward by the new company. So where the new company is deemed to be continuing in business, so the new company that is taking the other company is deemed to be continuing in business, any unrelieved loss of the individual companies can be carried forward by the new company. This seems to be contradicting what we've been saying before, that they can be transferred. They will not be transferred. They will have to be carried backward. They will be lapsed. But here, this provision here says that you can write to the FRS and tell them that you want to carry on the losses. That is, if it is not um, if it is not a new company. Now they said new company is deemed to be continuing in business. Now this could be in the case of a reconstituted company, because a reconstituted company is a new company, and it is deemed to be continuing in business because it is reconstituted to carry on the business of the foreign company. The unrelieved loss can be carried forward into the new company. That is what we learned in reconstituted company. So that's a tax planning. Where there is reinvestment of proceeds of sales of assets, then rollover relief can be claimed. So you see, we learned about in capital gains tax that when an asset is sold and it is rolled over, okay, then we find out that um, rollover relief can be claimed. So it means that the asset that has been transferred, okay, let's not talk about assets being transferred. So when there is sales of assets and you sell off some assets and you immediately purchase that similar asset in the same class, then you would have saved yourself paying capital gains tax by rolling over the assets. So this is some of the things we have learned here in the merger and acquisition. Most times, merger and acquisition are usually um in the form of theory, writing, advising. You will be asked to look for the tax implication, just all the things that we have learned today. It is just only on rare occasions that you'll be asked to do calculation. If you are asked to do calculation on merger and acquisition, just know that you are also doing commencement rule or cessation rule. That is the only time you will be doing calculation. So when you say two merging companies come together and they form another company and they give us the assets, they give us the business profits and losses, what they are telling you is apply. They want to know whether you know that you apply cessation rule to the old business and apply commencement rule to the new business. That is the only time you can see calculation. So it could be that it could be a question number one. Then they will ask you to do those calculation, another tax implication, and you do your calculation and you also do the other one that we've discussed. So let's see if we have merger and acquisition. None of them here is in question number one. Question number two, none. Question number three, none. Question number four, none. Question number five, none. Question number six, I can't see. Question number seven, I can see implications of merger and acquisition. Okay. Um, this November 2017, question number seven. November 2017, question number seven. Let me see if I can see that. November 2017, question number seven. It's opening up in a moment. November 2017, question seven. Now, this says here, the prevailing economic condition in the country has led to the business cessation of many small and medium-scale enterprises (SMEs). Aba Food Limited, based in Abia State, is a popular company known for producing high-quality foods and beverages. However, due to unwillingness of banks to lend on long-term basis, the company could not replace its aging and obsolete property, plant and equipment, which led to a trajectory of losses. The directors of the company and the elders of the community where the factory is sited pray that their products with household name of choice should continue to be popular given the acceptability of these products in the market. In the alternative, the directors went in search of prospective investors who might be interested in either a merger or total acquisition. They finally initiated discussion with Chief Egodi, a prominent businessman with a vast empire known as Ifedi Group of Companies. One of the companies in the group of Ifedi Foods and Beverage, sorry, one of the company in the group is Ifedi Foods and Beverage Limited, which produces similar products to Abia Food Limited. Now, you see something here, which produces similar products. So it means they're in the same line of business. If they're going to be merging or acquisition, this is going to be a horizontal merger. And if one of them is surviving, so it's likely that Abba Food is going to cease. It's likely that, you know, Ifedi Food might be the surviving. Who knows? Chifegodi, who is quick-witted, understands from experience in running his other companies that such business dealings will naturally attract the attention of the Federal Inland Revenue Service, but he is unsure of the tax implication of which of the option he chooses. Consequently, he approached his solicitors for advice, who in turn recommended your firm. You can put your name there and call chartered accountant for professional advice. Now, you are required to make a presentation in the form of advice. A. Explaining the implication of Aba Foods merging with Ifedi Foods and Beverage Limited, where the latter, who is the latter? Ifedi Foods, inherits all the assets and liabilities of the merging companies. Now, they are calling it merging, oh. So, when assets and liabilities are all of them are inherited, this is an acquisition. This is an acquisition. Now, explaining the tax implication if Ifedi Food and Beverages is reconstituted to take over the assets and liabilities of Aba Foods. So you see, reconstituted is here. It's as though the Aba Food is a foreign company. All right. Now, we now see explaining the tax implications if Ifedi Foods and Beverage Limited and Aba Foods enter into a joint venture agreement or partnership. So joint venture is another business combination. I'll be looking at the solution here. Let's read the solution because it doesn't involve calculation. So let's just go straight to the solution. So let's go straight to the solution here and read what it says. All right, so we said the solution should be in the form of advice, and now we are advising Chief Igodi of Ifedi Group and Company. Of course, your letterhead will be at the top. Put any address you like. There, sir. Implication. Read tax implication of various options in merger and acquisition. Now, you see, this requirement, all of these things will be in one advice. So you're not going to write 3 letters, just one advice. And all these A, B, C are different scenarios that you are painting. We write to advise on the subject matter as follows. Merger. This is an arrangement in which assets, liabilities, and businesses of two or more companies are vested in and carried on by one company which may not be one of the merging companies under a situation in which the new company is owned by the owner of the merging companies. Acquisition. This is an act of acquiring effective control over assets or management of a company by another company by acquiring substantial shares or voting right of the target company. Now the scenario starts. Tax implication of Aba Foods Limited merging with Ifedi Foods and Limited. Now, they said this is merging, but look at the situation they wrote here, merging with Ifedi Food, where the letter Ifedi Food inherits all the assets and liabilities of the merging company. So take note here. Ifedi Limited shall continue to file annual returns not later than 6 months. Why? Because it is doing the similar product just like Aba Foods. So it is still in the business. 2. Commencement rule shall not apply to Ifedi Limited. Of course, they are not out of business. It's not a new company. The company shall be assessed to tax on preceding year basis. No initial allowance on assets transferred. The claim of annual allowance on tax written down value of the assets transferred. All fees paid will be liable to VAT and withholding tax. Stamp duties will be paid on increase in share capital. Capital gains tax shall be payable by shareholders of Abba Foods for cash received for surrendering their shares to Ifedi Limited. Abba Foods Limited shall cease operations. So this is not just a merger, this is an outright acquisition, and cessation provisions will be applied in determining the accessible profit of the company for the relevant years. So we've answered that first scenario. The second scenario is about reconstituted companies. Tax implication if Ifedi Food and Beverages is reconstituted to take over the assets and liability of Abba Foods. There will be no application of the commencement and cessation rules. That's one. All assets, qualified capital expenditure are deemed to have been transferred at their tax written down value. That's two. In the computation of capital allowance, no annual allowance may be computed, while annual allowance, sorry, no initial allowance may be computed, while the annual allowance will be based on the unexpired tax life of the qualifying capital expenditure. Any unutilized capital allowance transferred are deemed to have been transferred prior to the sales. Reconstituted Ifedi shall pay stamp duties for any increase in share capital. Unrelieved losses of Abba Food Limited shall be carried forward for relief by the reconstituted Ifedi Foods, and it shall be deemed to have been incurred by the reconstituted Ifedi Foods in this first year of business. Now, this is just what we said when we are in our lecture. Now, the third one is if it is a joint venture. Tax implication if Ifedi Foods and Beverage and Abba Food enter into a joint venture or partnership. Now, one, the joint venture or partnership itself is not chargeable to tax. The profit chargeable to tax in the hands of each of the partners is the share of profit from the partners. So the profits that the partnership itself makes, so the partnership will prepare its partnership account. Now, when it has profit share, when it have partnership profit, that partnership profit is not chargeable to tax, but they will share it in to the partners at their profit sharing ratio. It is that ones that is going into the partners' hands that will now be taxable in the partners' hands. Share of loss can only be relieved from the profits of the joint venture or partnership business. The loss can only be relieved from the profits of the joint venture, so it cannot go to their other business. Capital allowances on the assets of the joint venture shall be shared on the agreed profit and loss sharing ratio. Where any of the companies involved in the partnership has another line of business, the loss generated from the business will not be available for relief against the profit generated from the partnership. We learned that in loss relief. So you see here, these are some of the tax implications. Then you put down your name and your name of your company. So this is the advice you give to the company that is asking for your service. So this is what we are learning today in the merger and acquisition. Then I want to take a few moments to talk about tax planning, avoidance, and evasion. Um, We may want to talk about it in the next class, but I just want to make you aware that the next topic we'll be talking about is tax planning, avoidance, and evasion. Then it may dovetail into discussing about um, tax audits and tax investigation. So that's the likely next topic we are going to take, tax planning and avoidance. And after that, what remains will be hydrocarbon tax and mining tax. So thank you so much for coming to our class today, where it has been a nice time learning about mergers and acquisition. I wish I would be able to see a question that has um, a um, calculation on merger and acquisition. I would have loved you to look at them so that you can see that when two companies are merging and you have a calculation there, you will be asked to do um, either commencement rule or cessation rule, whichever one applies. So we just couldn't see the question on that. So with that, we come to the end of our class today. So come prepared for the next class, which I mentioned will be tax planning, avoidance and evasion, and audit and investigation. So from me to you here, I say thank you once again and good night. Have a good night rest.